I'm Radhika Merwin, and this is a big picture on monetary policy. In today's session, we will look at why monetary policy cannot work in isolation to promote growth. In times of slowdown, banks in India Inc. have been clamoring for lower interest rates because they believe this is the only way to revive economic growth. Banks expect lower rates to trigger credit growth. For India Inc., the underlying assumption is that lower interest rates will make new projects more viable and hence companies will borrow more and up their capital spending. But the truth is that lower lending rates do not always trigger credit growth or new investments. Let us look at some past examples. Through most of 2007 and 2008, the RBI steadily increased its key policy repo rate from 7.75% to 9%. But this did not deter bank lending. The robust growth in the economy fueled credit demand. Bank lending grew at a healthy 25 to 30% during this period. When the RBI finally started to lower its repo rate from October 2008 to February 2010, surprisingly, bank credit also lost steam. Even in recent times, when the RBI reduced its repo rate from April 2012 to May 2013, bank credit scarcely responded. During this period, the growth in the economy fell below 5% levels. Hence, credit demand could not revive as long as the economic growth was so sluggish. This clearly shows that credit offtake or the appetite to borrow is more a function of the growth in the economy and the business confidence rather than the cost of money. Over the last 10 years, bank credit has grown at 2.5 to 3 times the growth in the real GDP, and this multiple has held steady in both good and bad times. Today, when the economy is going through one of its most troubled periods, bank lending has slipped to decade-low levels of 9%. Hence, credit offtake cannot revive unless there is a recovery in economic growth. But what has impacted growth? The growth in the domestic economy has been slowing mainly due to the slowdown in investment cycle. Delay in regulatory clearances and environmental clearances and lack of availability of raw material has stalled large projects in core sectors. This has impacted companies' cash flows. Hence, for these companies, capital that has been stuck in older projects deter them from borrowing new funds to put up new projects. In its review of the economy, the Economic Advisory Council has noted that for every rupee of capital that has been invested in assets, entrepreneurs have been earning lower returns. This has weakened corporate profitability and balance sheets and eroded investment sentiment. According to IMF, the real swings in interest rates account for only a quarter of the investment slowdown in India. Policy uncertainties and shaky business confidence have played a major role in the investment slowdown. Currently, the RBI has adopted a money easing policy and reduced repo rate. But bank credit growth has slipped to decade-low levels of 9%. To revive the economic growth, the capital that has been stuck in older projects need to be freed up. Indian corporates took on aggressive capex plans post the financial crisis and have already burned their fingers. It is unlikely that these companies will start to take on fresh debt to put up new capacities only because the lending rates have moved a few percentage points lower. These companies are likely to trim their debt even when the economy revives. To sum up, the RBI's rate actions do set the direction for the interest rates in the economy and can stimulate lending to some extent. But it is not enough to kickstart investments. The government's policy reforms play a major role to kickstart investments. With this session, we conclude the series on monetary policy. We have seen the various tools that the RBI uses to control inflation, promote growth, and maintain a stable exchange rate, like repo rate, term repo, SLR, CRR, etc. Hope you got the big picture on the monetary policy.